Welcome back to Downgrade, a special report talking about S&P's downgrade of the United States of America. No longer AAA. We told you at the beginning of the hour that we had a lineup of outstanding guests. Well, it continues. Here we are with legendary hedge fund manager Jim Chanos, president of Kynikos Associates. Jim, you tend to play from the short side. You have been negative on the rating agencies for 3 years, 4 years?
About 4 years now.
You've been dead right. You've made a lot of money. What do you say about the rating agencies right now?
Well, I think, first of all, S&P came out with this unilateral downgrade, and while the fundamentals behind it shouldn't surprise us, there were certainly a few things that raised eyebrows, not the least of which they seem to make more than just a rookie mistake by missing $2 trillion on the baseline estimate.
Although J.P. Morgan actually defended him and said you ultimately get to the same place, allowing for the war costs and the fact that GDP assumptions are too positive. Right,
but S&P didn't say that. And the Treasury walks you through on their website just the mistake they did pretty clearly.
Right.
Having said that, look, are there any AAAs out there, quite frankly? And it's sort of interesting that one of the entities that probably got us at least along the way to an additional $3 or $4 trillion of debt, the rating agencies themselves,
right,
by their inability to point out that AAA securities in 07 and 08 were not AAA, bringing on a lot of the financial problems, in which case we issued more debt to cover the bailout, now turns the tables on the government itself. The irony is not lost.
Well, I tell you what, we spoke to John Chambers of S&P earlier. He's the man behind the downgrade, runs the Sovereign Ratings Group. Listen to what he told us.
We wanted to do it after markets closed. And we talked to a lot of people. They asked us that if you're going to do this, that it would be least disruptive to markets if you did it after the markets closed and did it on a Friday.
Wait a minute. Did we just hear him correctly? We asked a lot of people about the timing of this.
I heard that in my apartment right before I came over here, and I almost jumped. He basically...
is that what you do before you downgrade the United States of America?
I assume he's talking to at least attorneys and advisors that are fiduciaries, but who else did he talk to, and how many people knew about this?
Well, admittedly, we did ask him, and their unofficial statement was, we spoke to members of the government. They weren't speaking to private investors such as yourself.
No, I hope not. That's a pretty market-moving information to be sharing with a lot of people.
That would be inside information.
I don't know about that. I'll leave that to the lawyers, but I'm saying it would be pretty amazing if a lot of people knew this.
So the rating agencies at this point, in a world where there are credit default swaps, where risk is priced are they relevant? I
think they're not, and that you bring up a great point, in that in a market where you have the credit default swaps existed, and whatever you might think about them, particularly in the sovereign market, you have a marketplace every minute of every day talking to itself and saying, where are we repricing this risk? For example, right now, Chile has a credit default spread lower than France. France is a AAA credit. The market is saying Chile is a better credit than the AAA credit of France. So it's very interesting that all along, including through the real estate crisis, going all the way back to Enron and prior to that, the CDS market did a far better job in pricing risk looking forward than did the rating agencies.
So do we no longer look at the rating agencies? Obviously they're having an impact this morning. Futures are down 250. We only have about 20 seconds here.
Yeah.
And then we're going to hold you over after the break.
Fine. Again, I think that market players look at the marketplace itself. Ratings are basically there for legal reasons, for institutional reasons, but real market players look at the CDS market, not ratings.